Nvidia shares are nearly 3% higher here in the after hours following those earnings. Jared Blikre joins us now to check in on how the numbers are impacting the rest of the markets. Jared.
Josh, we almost had $1,000 for Nvidia in the aftermarket, and you can see right now it's only at 974.87. That is good enough for a 2.66% increase over the closing number, and that number that we got only minutes ago was 949.50. Now there are about $2.5 billion shares outstanding. So if you do the math at $1,000 per share, you're going to end up with a valuation of $2.5 billion. So still not to $3 trillion like Microsoft or Apple was prior, but inching up there. So I thought it was really interesting to see the commentary. Gross margins just knocking it out of the park. The actual beat for the current quarter, for the reporting quarter, not as big as people might have liked, but nevertheless, it's all about the forward guidance. And I should say something about the stock split as well. 10 for 1, that's going to happen on June 7th. As we've talked about, typically a stock split or a reverse split, that's where shares are increased, isn't supposed to really affect the bottom line of the company. It's just a mathematical exercise. But this does make this very expensive stock, $949 or $978, depending on your quote. That's going to be brought down to $94, $97, $98, $100. So that will also put it in candidacy for, in addition to another index. I'm not going to throw the name out there. I don't want to start rumors, but typically you do want to have those lower price tags for these consumer-facing stocks, and that's what Nvidia now is. It's a poster child for the AI revolution. Now, let me check in on some of the other semiconductor stocks that are trending here, and you can see the background colors here. Those represent what happened during the day. It's those little rectangles that show you what's been happening in the after hours. I should point out that Supermicro up 1.8%, ARM up 1%, so there's a lot of follow-on trading here as well.